So in this session, let's see the modeling piece, which is I'll show you how to practically implement the binomial tree model. Okay. And how can we use binomial tree to price European option in this case. So I have taken this contract from Yahoo Finance. So like how the contract is actually given is something like this. You have a call option and you have a put option, and this is how the contract will be given. Basically SPY 240709C00 55500. So this is how the contract name is given. Now you might be thinking why there is such a big name, but I'll tell you. Uh, this will actually give this the just the contract name will actually give you a lot of information. So just remember this SPY 240709C00 55500. So this is our contract name. So just to make sure, just to let you all know, I have taken this contract from Yahoo Finance. Okay. So the contract name is this. Now how to understand this contract, or what can we do to take out the maximum information just by the contract name. Okay. So SPY, which basically means that the underlying stock in this contract is SPY. Okay. Then once we get that, this then the second piece, which is the year, month, and the date, which is nothing but it is 9th July 2024, which is nothing but the date of expiry. Okay. So the day wherein I was checking this when I was checking this contract was 2nd July 2024. So on that day, I was looking at a 1 day expiry contract, sorry, 1 week expiry contract. So if you see this, the so basically the it starts from 2nd July 2024, and the contract expires at 9 July 2024. So a quick question asked by Pariveshus, what is SPY? See, SPY is nothing but S&P 500. Okay, SPY stands for S&P 500. So this date is nothing but a date of expiry. C, what is C? C is nothing but call option. Okay. C is nothing but call option, and if it's a put option, there will be P. Okay. And then you see this number, 55500. Always remember the end piece. Okay, 55500, you have to divide by 1,000. So when you divide by 1,000, you will be left over with 555. So that is nothing but your strike price. Okay. So now if you see, just by the contract name, we have gotten so much information. That is what is the underlying of the contract, when is the contract expiring, whether is it a call option or a put option, and the last piece is what is the strike price. Always remember, you have to divide the number with 1,000 so that you arrive at the strike price. So this is what we have taken into consideration at that day. The stock price was 549. And can you all so this was how this is how the information look like. By mistake, I guess I have written this duplicated this information, but just leave over. Okay. Okay, so now let's start our modeling piece. If you all remember the steps, what was our first step? That Okay, so I've just written here all the steps so that it's easy for all of you to follow. The first step is to calculate the time step, which is delta t is equal to t by n. Second step is to calculate the up and down factor. Third step is to calculate risk neutral probability. Fourth step is to construct binomial tree. Fifth step is to calculate the option payoff at expiration. And the last piece is backpropagating the option values. Okay, this is the structure that we have to follow for arriving at the option, for basically valuing this contract. Okay, so that we can arrive at the value of this option. So this is how it looks like. This is the screenshot I took from Yahoo Finance. The only difference between these two is what this is a call option contract and this one is a put option contract. Otherwise, both of them are 1 week expiry, and this one is priced at 0.4, whereas the put option is priced at 9.95. Okay. So this is the information that we have. So now let's start our modeling piece. Okay. So can you all tell me one thing? We have to calculate what delta t. Delta t is what? T by n. Okay, where t is what? Time to maturity, and n is what? The number of time steps. Okay, so if you all see how many, okay, so this was our starting day, right? This was when, if you see, 2nd July is the current date, and it's expiring at 9 July. So this is 2nd July, 3rd July, 4th July, up till 9 July. Okay. So what I'm trying to do is I'm trying to calculate the number of trading days. Okay. So how many trading days are there? There are total 6 trading days. For Saturdays and Sundays, I've put 0 because there are no trading activities on Saturdays and Sundays. Otherwise, the number of days that we see is 6. Okay. So there are 6 trading days between these two dates. Okay. So T is what? 6 by 252. If you all see, what I've done is I've taken 6, which is the total number of days, divided by 252. Now you might be thinking, Mehul, why in a year there are 365 days, right? But always remember, these are calendar days, okay? These are calendar days. But when we do the modeling piece, we always take into consideration the trading days, which is what? 252. Okay. How you arrive at 252? You just subtract the number of Saturdays and Sundays, and you also subtract the national holidays, and that's how you will arrive at 252. Okay. So what I'm doing is, first I'm calculating the maturity. So we know that this contract is expiring in 6 days. So 6 divided by 252 is nothing but a maturity. For simplicity, we have considered our risk-free rate is 5.5%. Okay, this is just for consideration. Okay, now if you all remember, so if you all remember, we have to calculate delta t, which is this step. Okay, so delta t is what? T by n. How much is n? If you see, what is B12? Okay, B12 is 5. Why we are considering 5? If you see, number of steps is what? 5. Why we are considering 5? 5 is because, if you see, when we are constructing a binomial tree, we are considering it will go up to 5 steps. Okay, so we are saying that we are growing our binomial tree up till 5 steps, and we all know what is the formula. Delta t is equal to t by n. N is the number of steps, which is 5 in this case, and capital T is what? 5, sorry, 6 by 252. Okay, so this is our capital T. So now we have calculated our delta t. Okay, we have calculated our delta t, which is nothing but t divided by n. Okay, so a quick question asked is, why 5 steps? This is just for illustration purpose. I've taken 5 steps. If you want, you can take more steps. But I just want, if you want, you can take just 3 steps, or you can take 4 steps or 10 steps, whatever it is. See, the more number of steps it is, the higher the accuracy will be. Always remember, the more the number of steps, the higher the accuracy. So I have just consideration 5 steps. Okay. So the first piece is completed, which is calculating delta t. Now calculating the up and down factor. So we all know that we have already calculated delta t, which is, which we have, if we have, basically we have covered the square root piece. Now we have to calculate sigma, right, which is equally important. So how can we calculate sigma? So for calculating sigma, which is the volatility piece, what I've done is I've considered the last 1 year historical data. So if you see, my contract starts from 2nd July 2024. So 1 year before that. So basically, what I have done is I have taken the data from June 30th. Sorry, yeah, 30th June till last 1 year. If you, sorry, 30 from 30th June 2023 till 1st July 2024. So I have considered the SPY data and just calculated the returns. Okay, just calculated the returns. So so how will calculate the return? I have showed you this, which is nothing but whatever price we have today, divided by the price yesterday minus 1. That's how we will calculate the returns. Okay, so always remember how we calculate return is price today. Okay, price today divided by price yesterday minus 1. That's it. That's how you calculate. So if you see here, so price today is what? 7/3/2023, right? Which is 437.668. And price yesterday is what? Price yesterday is what? 437.165. So that's how we'll calculate the return. Okay. So a quick question asks is, uh, did I consider log return? See, there are multiple ways you can calculate return. Okay. So you can either calculate something like this price. So log of price today by price yesterday. But mostly because I take into consideration this specific formula. Why? Because I've seen when we do a Taylor expansion, this is what returns were actually considered. Okay, so this is more from a mathematical piece. Why we consider, why I have considered this? Because when I'll teach you more about quant modeling, so a lot of times we use Taylor expansion. And the for Taylor, when we use Taylor expansion, I do see like we generally take this kind of return, which is price today divided by price yesterday minus 1. But once we calculate the return, okay, what is the next piece? The next piece is very simple, right? We'll just utilize standard deviation, because end of day we have to find the volatility, right? So, you see there are two types of volatilities. So we are calculating standard deviation. So standard deviation population and standard deviation sample. So you might be thinking which one to take. Okay, always remember we will always consider a standard deviation sample. Okay, for all the use case. And why is that the case? Because whatever, see, we have considered just 1 year of data. If you see, we have just considered 1 year of data. So this is just a sample of sample of data. We have not considered the entire data. And that's why when we are considering 1 year, 2 year, 5 year, 10 year, this is just a sample. We have not considered the complete data set, right? So that's why how we'll calculate, which is standard deviation dot sample, and we'll just give the returns. So this is what we have gotten, the one day standard deviation of our portfolio. Okay, so we need to annualize it. Okay, always remember we have to annualize our volatility. So how will we annualize? By multi. So this is our 1 day volatility. We know that there are 252 days of trading days, so we'll just multiply it with square root of 252. Now you might be thinking why we have not multiplied by 252 and why we have taken square root of 252. But this is convention, that whenever you calculate 1 day volatility, you always multiply with the square root of the number of trading days. So let's say this is annual, so this is 1 day volatility, and this is annualized volatility. Okay, so this is what annualized volatility. Okay, this is annualized volatility. If let's say I wanted to find 10-day volatility, I would have just did this multiplied with square root of 10. Okay, this is what is 10-day volatility, but we have to consider annualized volatility. Okay, so just remove this. So this is 11.10 is our annualized volatility. And why we are calculating volatility? Because it is a very important piece in our up factor and our down factor calculation. So now we have sigma, and we already have delta t from our first step, right? So if you see, so I have just did the same calculation here. Okay, and so we have volatility. Okay, and we have delta t. So now we can easily find up factor and down factor, which is exponential of volatility times square root of delta t. Okay. Okay, so quick question asked in the doubt comment section is, do we extract adjusted close? Yes. Okay, so always remember when you extract the data, you will see open value, close value, adjusted close value, high, low value. Always remember, we always have to consider adjusted close, because that is the true picture of the stock after the day ends. Okay. So what happens is, generally, you see sometimes close and adjusted close values are different. And why they are different? Because a lot of corporate actions happens. If there's a big corporate action that has to happen, that sometimes they happen after the trading hours. Why they happen? Because regulators know that if the corporation do that between the trading hours, there will be a lot of volatility in the stock, right? So just to avoid that, there are a lot of actions, corporate actions, which are taken after the trading hours. And that's why you always have to consider. So that's why the close value, you know are sometimes adjusted, and that's why you always have to consider the adjusted close value. Okay, so a quick question by Venkata is, why did we use square root? Okay, so always remember that. Okay, so we have our adjusted close values. Okay, we calculated our returns. Now, to calculate the standard deviation, we have. Okay, so when you calculate the standard deviation, if you see, there are two things: standard deviation dot p, standard deviation dot s, right? Always remember that. Tell me one thing: is this a sample of data, or is it the complete population? This is just a sample of data. Okay, this is just a sample. We have not considered the entire SPY data. Okay, we have not considered the entire SPY data. If we would have considered the entire SPY data starting from whenever it started till the end, that's where we would have taken standard deviation dot p. But this is just last 1 year data. We have just considered last 1 year data. That's why we see std dev dot sample. That's, we are just calculating the sample. So whenever we use this formula, okay, the way Excel gives this, or tells or share or gives the output is, it basically says that this is a 1 day volatility. Okay, this is a 1 day volatility. But now to arrive at this piece, which is the annualized volatility. Sorry, to arrive at the annualized volatility, what we do is we multiply the daily standard deviation. Okay, so let me write this as 1 day standard deviation. Okay, and this is nothing but annualized standard deviation. So to arrive from 1 day standard deviation to annualized standard deviation, we just multiply the 1 day standard deviation with the square root of 252, because we assume that there are 252 trading days in our data in 1 year. Okay, as I said, you might be thinking there are 365 days, but those are calendar days. Okay, we do not consider calendar days. We always consider trading days. Why is that the reason? Because in trading days, there are no Saturdays, no Sundays, and no public holidays, and that's why we have to remove all of those, and that's why we arrive at 252. So this is a convention that whenever you do 1 day, whenever you complete 1 day standard deviation to annualized standard deviation, you multiply with the square root of 252. So that's how we have arrived at volatility piece. We have delta t. So that's how we'll calculate u and d. What is, if you all remember, what was the formula of u? E sigma times e raised to the power sigma times square root of delta t, right? So we have used the same exponential. Then we have this sigma and then square root of delta t. Okay. Similarly, we'll calculate d, which is nothing but 1 by u. Okay. So this was our step 3. Sorry, step 2. Step third is what? Calculate the risk neutral probabilities. How will you calculate the risk neutral probabilities? By using this formula, E R delta T minus D divided by U minus D. So if you see, from step 2 we have U and D, and from step 1 we have delta T. So we'll just input the values of delta T, U and D to arrive at P. Okay. So if you see, if you see here, what is P? P is nothing but E. If you see, E R delta T minus D divided by U minus D. Okay. So I've just implemented the formula. I've not done anything else. Okay. So this will give us, okay, so U is our upward movement, okay, D is our downward movement, P is what? Probability of upward movement, and D is what? Probability of downward movement, okay. So now, if you all remember, I told you that the probabilities of upward movement and downward movement, when you add it, it should come to 1. If you all see in the bottom of this Excel, the sum is what? 1, which means that at least from the calculation perspective, we have done it correctly. Okay. So now everything is done. All the pieces are done. Okay. Step 1 is done. Step 2 is done. Step 3 is done. Now the step is to construct the binomial tree. Now, how will we construct? Let's see call option. Okay, let's see call option. So we know that at present price of the stock is what? 549. Okay, so now we know that S naught. Okay, tell me one thing. So this is S naught. Okay, S naught. How so S naught times U, and we'll do S naught times D, correct? Correct or not? To arrive at the up movement price and the down movement price. Is it correct? I'll wait for everyone. So we just saw this concept, right? We have we have S naught to come at upward price, and downward price will just multiply with U and D. So we have S naught. Okay. So what is the upward price? S naught times U. Okay. So if you see S naught times U is our upward price, and downward will be what? S naught times D. Okay. So a quick question asked by Achint is, can this tree have maximum steps t equal to, it can have anything. So this t equal to 0, 1, 2, you can go up till 2 t equal to 252. The issue that happens is the computational cost become expensive, right? I mean, it will take more time to build the whole tree and perform the whole calculation. And if you see, if you talk about any corporation, any financial institution, they do not have just one instrument. There'll be a lot of European options, right? Almost like close to 1000, 2000, or even 10,000 options, right? You never know how many option contracts they are dealing with. So just imagine if one contract is taking a lot of time. Just imagine the time it will take for the whole portfolio. So that's why you have to make sure that whatever model you are using should not be computationally intense expensive. Okay, when I say computationally expensive, I'm not referring to the money, I'm referring to the time cost. Because the trading are done in milliseconds. Also in HFTs, the tradings are done in milliseconds, and that's why it becomes very important to price as quick as possible. Okay. So so do you all understood how did we arrive at this? So this is nothing but we multiply S naught with U to arrive at S naught U, and similarly as we multiply S naught with D to arrive at the down price. Now again we'll use the same thing. Okay, we'll multiply this with U, and similarly we'll multiply this with D. Same thing will happen again. Multiply this with U and multiply this with D to arrive at this formula. Okay. Okay, so a question asks this, but since the option will expire after 6 days, why do we calculate for more than 6 days? Okay, see, these are the time steps. Okay, these are the time steps. These are generally used to perform the calculation. Okay, irrespective of t. So just imagine like this, right? I mean, we calculated delta t, right? And this is what is basically difference between this, right? This is just the number of steps you want to do. This is not the time. Okay, t equal to 1 2 3 is just the number of steps. Okay, always remember these are just the number of steps. If you want to increase one more, so there will be t equal to 6. Okay. Okay, so moving on. So this is how you will construct the tree, fully you'll construct the tree like this. Okay, you'll just multiply S naught with U, and S naught with D to arrive at this final tree. Is it clear? Is it clear to everyone? How did we arrive at the? How did we make this white part? We just need to multiply the previous stock price with up and down. Okay, just need to multiply the previous stock price with up and down movement. That's it to arrive at this. So the white is nothing but our stock movement. We all know that once we constructed our binomial tree, right? What was our step 5? Calculate the option payoff at expiration. So now how will you calculate the option price at expiration? Simple. Maximum of st minus k comma 0. This is our st. We know that k is what? 5555, right? Which is our strike price. So just we need to use this formula to, we'll use the same formula here, here, here. At the maturity we'll use this formula. Okay, so this will give you the option price at the maturity, which is $15, $6. And why is it 0? Because the stock price has gone below the strike price. What was our strike price? 555 was our strike price, right? So if you see the strike price, what was 555? So why is it 0 here? Because the stock price has gone below the strike price, and that's why it is all 0. So now we have calculated the options at the maturity, right? So what is the last step? The last step is just the back propagation. Remember this formula, we are multiplying P with up, 1 minus P with down, and then whole multiplied by E minus R delta T. This is just the discounting factor, okay? So let's say to arrive at this, okay, to arrive at this, okay, what we are doing is b16 is nothing but our p value. If you see b16 is nothing but if you see b16 is nothing but p value, okay, and b17 is 1 minus p. So if you see this sorry, if you sorry, my bad. If you okay, sorry. Mm, sorry, yeah. So now we have calculated our why we have calculated our options at the maturity, the payoff at the maturity. Let's back propagate it. So b16 is a p value, p multiplied by k7, which is this value, which is up value. B17 is our down probability multiplied by down value, which is K9. Okay. And then we are just discounting it off, exponential of R delta T. Okay. And delta T, as I said, will remain constant. So why? Because the time steps on delta T is constant, will remain same between all this thing. Okay. So just remember, we'll just back propagate it. Similar. So for this, you will use this value and this value. Similarly, for this, for arriving at this, you will use this value and this value. Similarly, for this, you will use this value and this value. So just see, again we'll use this the same thing, p times up option value 1 minus p times the down option value, and then discounting it off. Okay. So and see, just we all know that if the up value option value and the down option value is 0 0, so of course the whole term will become 0, right? Because if you just see this, p times 0 plus 1 minus p times 0, everything will be 0, right? If p times 0 is 0, 1 minus p times 0 is 0, and whole 0 multiplied by e negative r delta t is again 0. So that's why you see here everywhere, sorry, that's why you see here everywhere it's 0. Why? Because as I said, for this we are using, for this we'll be using what? This, sorry, for this we'll be using this and this. Similarly, for this we'll be using this and this. For this we'll be using this and this. Okay. And since these two are 0, this will 0, this will be 0. These two are 0, this will be 0. These two are 0, this will be 0. So again we'll back propagate in the very similar fashion. So for arriving at this value, we'll use this value and this value. For arriving at this value, we'll use this value and this value. And similarly, for arriving at this value, we'll use this value and this value. We are just back propagating it, is what is the essence of it. Okay. So how will we back propagate? We'll use the same formula, p times up option value, right? Then 1 minus p times our down option value, which is 3.48. Okay. So like this, will back propagate it till the end, and we'll use the same formula. We are not changing anything. So for to arrive at this, we'll use again the same formula, which is what? P, which is what? P times B times this value, which is up value, 1 minus P times the option down value, right? And then just discounting it off. So this is what our call option price is. Okay, this is what our call option price is, which is 1.71. Okay, now if you see Yahoo Finance, it was trading at zero point 0.4. Okay, this contract, if you see the call option contract was trading at zero point 0.4, but using the mathematical model, right, we realize that this option is trading at the real value of the option is what 1.7. So can you all tell, was it undervalued or overvalued? Can you all tell this option was trading at what? 0.4. This option was trading at zero point 0.4. Sorry, by mistake, sorry, yeah, this option was trading at zero point 0.4, and the actual price is what? 1.7. So this is undervalued. Why? Just imagine something like this, right? I mean, let's say there's this option whose price is in the market it is trading at 10, but its actual value is 100. So it is undervalued, right? Because the actual value is 100, but it is still trading at 10, so it is undervalued. So there are a lot of insights which you can use, to play with this. But again, this was how the binomial tree looks for a call option. Is this clear to everyone, or do you have any doubts? Okay, perfect. So the only thing, so let's do a put option, and this will be fairly quick. Only thing that changes between call option and put option is what? The final option formula at the payoff. So we know that for call option, for a call, sorry, yeah, for call option, we were using the formula as maximum of st minus k comma 0. But for put option, we'll use formula as maximum of k minus st comma 0, right? So if you see in both the cases, if you see the stock prices will be the same. If you see here also, the stock prices will be the same. It won't change, right? If you see 570 here, 570 here, 6.76 here, 6 point, oh sorry, 570 here, then 561, 553, similarly 561, 553, 528, 528. So there will be no changes in the stock. There will be no changes in the stock price. What will change? Only the formula for at the maturity will change, because it is a put option. So we'll take maximum of k minus st comma 0. Okay. So instead of using, so if you all remember, what we were doing was for call option we were using maximum of st minus k comma 0, but for put option we'll use maximum of k minus st comma 0. Okay, so you see we use the formula maximum of k minus st comma 0 at the maturity, and when you back propagate it, that's where you'll use the formula that we have derived using the derivation. Okay, which is p times up movement. So this b16 is nothing, probability of up movement. K27 is what? Your option up option value. B17 is nothing but 1 minus P. K29 is nothing but this value, which is the down value. And this, we are just discounting it off. Okay. And similarly, we see this, which is nothing but P times up value, 1 plus 1 minus P times the down value, and just discounting it off. And once you do this, you'll back propagate it. And in the end, also, you'll see P times G31, which is the up value, 1 minus P times the down value. Okay, and this is how you will arrive at the put option price, which is nothing but 6.98, but the option was been trading at what? 9.95. If you see, the option was trading at 9.95, but what we found the value using the binomial tree was what? 6.98. So is it clear? Yes, so for call option, that is correct, it is undervalued. Okay, for call option it is undervalued. See, a lot of times these methods are used for multiple purposes. Okay, it can be used for pricing the instruments, it can be used for hedging purposes, Because can you, do you know how can we use the same method for hedging? Do you all know? See, what is hedging? Delta. What is delta? Change in option price with respect to, change in option price with respect to what? Change in underlying, right? Underlying stock price. Let's say, we here we know that. So we know what is delta. Now we have a model which can tell what is the option price at a given stock. So if the stock price changes, we can again calculate the option price at the at whatever stock price has changed, and just we have to calculate the change, and that's what will give us delta. So that's why these models are important. Why? Not just for not just for pricing purpose, but also for hedging purposes also. So after you calculate the option price, the next step is to perform Greek's hedging, which is delta, gamma, rho, theta, vega. So that is correctly mentioned. Okay. So now we know that the call option price is undervalued. This call contract is undervalued, and the put contract is overvalued. Why is it overvalued? Because see, the actual option price using a model is 6.98. Let's say 7, and this contract has been traded at 9.95. So that's why it is overvalued. So just to summarize, call option contract is undervalued, put option contract is overvalued. Any questions, guys? I know we are on time, so any questions? Final question. But just remember, I'll just walk you through this again. So what you have to do is first you have to make sure you whatever stock price you have, just do this construct this binomial tree of upward movement and downward movement. After you do this upward movement and downward movement, calculate the option payoff at the maturity, which is a simple formula: maximum of st minus k comma 0 for call option, and maximum of k minus st comma 0 for put option. And once you calculate the option payoff at the maturity, then you need to back propagate it. So for back propagation, we actually use the formula that we derived from the derivation, right? So we'll use p times 1 minus p times fu plus 1 minus p times fd, and this whole multiplied by exponential of minus r delta t. So and similarly will back propagate and finally arrive at the option price. Okay. So let me so if there are no doubt, let me stop recording.